Hello everyone and welcome to the channel. My name is Brent and in today's video we're going to go ahead and cover the M1 Finance Roth IRA portfolio. We're going to be taking a look at the overall performance of the portfolio, take a look at the 1 week performance. I wasn't able to make my Monday video, but here on Tuesday we're going to go ahead and cover 3 companies, one of which we are going to be buying here this morning on Tuesday. And also going ahead and screening a few others just because I believe that they are showing good signs of recovery and could be potential buying opportunities. Also in the M1 Finance portfolio, we're going to go ahead and take a look at some of the activity as far as recent deposits and dividends that were paid out. And then we're going to go ahead and do our screening process and buy our company. One of the 3 that we are going to be screening today, so definitely stay tuned for that. With that said, if you are brand new to the channel, have not yet subscribed, go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time we release a brand new video, and of course give this video a thumbs up, make it blue, and let's go ahead and get into the video. Okay, so right off the bat, I want to quickly go over stock futures going into Tuesday. I wasn't able to buy anything on Monday. I had a ton of sun on Sunday, so I crashed pretty early here on Sunday, so didn't make my Monday's buys video. But as far as the market goes, the S&P 500 is up currently as of 3:21 a.m. at 0.02. The Nasdaq is up or down by 0.09, and the Dow Jones is up by 0.16. Now, the Nasdaq being the negative one today put on nearly a 1% gain there on the day, breaking to some new all-time highs and closing just 5 points off their all-time high for the day. So really high up there. The Nasdaq coming in second place, I believe now, year to date. Currently, the S&P 500 is up number 1 year to date. In second place is the Nasdaq, up 12.51, and Dow Jones has now fallen back into third place, up 12.01% there year to date. Here on Monday, pulled back by 0.44%. So there's some of the news of the current Nasdaq. S&P and the Dow and the Nasdaq were positive, whereas the Dow Jones was negative, and that was mainly because the FANG stocks helped out the S&P and the Nasdaq, whereas the Dow Jones, I believe that they had some, Disney, I think was one of the articles that I had read recently, or one of their cruise lines didn't go as planned. So, some of the testing for what had happened in 2020 kind of came back negative and had affected a number of cruise lines for that news that had broke. Now, over on my community tab, I put out a questionnaire. If you guys are interested in answering, go over there, just drop me a comment. What is your favorite REIT? And I'm currently looking to get about 5 different REITs. Look for an opportunity at the moment. Also keep your eye on Kimberly-Clark. So definitely drop me a comment over letting me know what your favorite REIT is, and let's go ahead and jump over into the M1 Finance Roth IRA. Now we're going to go ahead and take a look at the overall performance of this portfolio and see what stocks are up, what stocks are down, where have we made the most return and the least return of this portfolio so far. So number 1, Apple has brought us in the most return over the time frame here of 3 years. Apple up 200 and some percent there, over $1,000 of capital gains. And I had actually sold quite a bit of Apple, and now had I just held it, it would be much higher than what it is now. And I still hold it within my other portfolios. Just, here, for whatever reason, I kind of sold it off and never bought back into it. Main Street Capital, number 2. Lowe's, number 3. Avery Dennison, number 4. So those are my top 4. And our top 4 losers. Now, 4 of these have actually been added in here recently. Clorox is a fairly new position, only down roughly $51 or so. I believe I only put $2,000 into that. This is showing down $67. I'm not sure if I had averaged more into it since my initial buy of $2,000. So Clorox is down just slightly. This is showing some wacky number of down 25%, and that is incorrect. Simon Property Group is one of the longer standing positions in the portfolio, and that's down roughly 12.85. Merck is a new position in the portfolio, only down 2.14. Colgate is a new position in the portfolio, only $82 in there, and that will be one that we're going to be covering in today's video. Only down roughly 0.24. And Hormel Foods was another one that we recently added into our portfolio. This was last week's buy. I don't know if I cover that in a Monday's buys video, but we did buy into Hormel Foods, and that is up by 0.29% currently. So those are our top 4 winners and losers. Now, as far as the 1 week performance goes, we had actually put on a nice gain over the past week. On Monday, it looks like, we had actually lost a tad of it, down 0.06% here on Monday. But over the 1 week, with Monday of last week, unincluded, and this Monday being negative, that put the portfolio positive by roughly 0.79, but I'm pretty sure it had actually been positive a bit more. I just didn't track it there right away. Now, as far as the 1 week goes, we can see Clorox up really nicely, up 3.79%. So it's making a comeback off those recent lows. IIPR up 3.76, Siggy up 3.4, Stanley Black & Decker up 3.04. So Clorox, IIPR, and Siggy, these are all new positions here as of 2021 that I recently purchased into the portfolio. And then we can see that our top 3, positions that are down for this past week are ABM Industries, Digital Realty Trust, the Southern Company. So interesting to see Avi there. I would like Avi to fall down into the low 100s or even 90s. That would be a really good opportunity, but I doubt it will happen. So that is the overall performance and our 1 week performance as far as companies, top 3, 4 up, top 3, 4 down. Now, as far as some activity, last week we had 2 companies that paid out dividends. They were Stanley Black & Decker, paid out $3.42, and Lockheed Martin, paying out $7.27. And then also on Friday, we made a deposit of $201.42, giving us our grand total of $212.11 that we are going to be investing into the market today. So, bam, we're going to go ahead and invest that $212 into a company here, as we're going to go ahead and screen it right now. Now, we're going to go ahead and cover 3 stocks, as we kind of said earlier, and I'm going to go ahead and give you guys a breakdown of the company that I'm buying, kind of why I'm buying it at this time. One that I feel is more favorable as, a growth opportunity, and then one that I'm watching because I do feel that it could potentially be of a value, but I think it still has, some rough patches in its future. So it could also offer some better opportunities to buy into it. So Procter and Gamble here, let's take a look at the overall performance over the past 1 year. So Procter and Gamble here, as of July 2020, it actually had a huge growth spurt up until October of 2020. And then as of October, November, it has hit those highs and has trended down quite a bit from roughly 144 to now sitting at roughly 135.32. So it is sitting splat in the middle. Let's go ahead and look at the 3-month here. It is sitting at basically the 50-day and 200-day. So right now we have the 200-day that is kind of trying to keep above the 50-day. 50 days, if the 50-day breaks above, so this could have been a really good opportunity had Procter and Gamble continued to move to the upside, keeping it consistently up. We may have seen a golden cross where the 50-day crossed over the 200-day, and they may have reverted back, used the 200-day as support, but in this case, the price had broken back down, hit these lows of around 132, bounced, and now it is hitting that 50-day, 200-day moving average, but it's acting more of resistance at the moment. If it can break and kind of keep up upwards momentum, then this could be a buying opportunity where we may see it break to some new all-time highs. But here, I'm going to go ahead and continue to watch Procter and Gamble. It may break down back into that $134, $135 range, even down all the way to $132 if it's not able to break here. If it does break beyond the 50-day moving average. It's already kind of broken there. If we kind of zoom in just a 1 month here, we can see that the price has climbed over the 50-day moving average, but it has to break through the 200 and then stay up there. It could be in that 136, 137, but if it doesn't continue moving higher, if it breaks back down, it could fall even further or even retest those positions and kind of act as support there. So Procter and Gamble was one that I thought I had in my portfolio. It may have been in my portfolio at one time, but I may have sold out of it just for some more growth. But it is one of those companies where if you have the opportunity to average into it, buy into it, and average into it, then it is a good position to hold for the long term. Now, overall, Hormel Foods here is another position that I added into my portfolio. I believe of these three, it has the highest growth potential over Colgate and Procter and Gamble. Well, at this moment, I'm kind of splitting between Colgate at the moment and Hormel Foods. Colgate, I feel, has a better valuation and buying opportunity versus Hormel Foods. Hormel Foods here is at $47.77. It is using its 50-day moving average as support here. If we go ahead and zoom in here. So Hormel Foods broke above the 50-day, 200-day, and was trying to use that 200-day as support. But what had happened here recently in June was it actually fell below, broke below support of that 200, hit the 50-day, is currently using the 50-day average as support, but it could break down back into some April, May, those low 40s before bouncing back up. So I'm kind of just watching this one again. I bought a little bit of it last week, and I'm kind of waiting to see, is there any buying opportunity or will it continue to downtrend? So if it does downtrend, that'll be good because I'll just buy a little bit more of it next week. Right now, it's just, I'm not buying a whole lot of it with any of these positions. So anyways, I could go back and actually buy Procter and Gamble, but I feel that Procter and Gamble may offer a better opportunity. And I've also recently started positions in Hormel Foods and in Colgate. So I want to use this time right now. Unless Procter and Gamble breaks down pretty hard, then I'll probably focus more on Hormel Foods and Colgate. But right now, I'm holding on Hormel Foods. If it does break down, I'll probably buy more in the upcoming weeks. But we'll also cover their valuation here in just a minute, or their financial other metrics here. And then Colgate here, the reason I started picking up Colgate and buying more of it is we had a golden cross here, 50-day cross over the 200-day, started moving higher. And here, the Colgate broke down, hit the 200-day moving average, acted as support, bounced very nicely off the $80.65. Now moving up to $81.72. If it can break over the 50-day here at $82.22, it'll use that as support and continue moving higher. Plus, all of these companies have strong brands behind them. You go to the store, quite a bit of the Colgate products, quite a bit of the Hormel products, and Procter and Gamble. So they're all pretty common household names. So I don't feel that there's any sort of risk in buying into any three of these positions and then averaging in as we are doing here on the portfolio. Now, as far as their other financial metrics, so Colgate shows the most upside potential. It's already broken through its 200-day moving average here recently. It's using as support, and kind of broke back through. And now if it can break above the 50-day and use that as support and move higher, it can just continue to trend higher and go back up into the 85 or even push higher than that. So let's go ahead and look at 5 years here for Colgate and look at it percentage-wise, because that's always kind of nice to kind of see. We could either do 5 years or 10 years. So Colgate here, over the past 10 years, it's a very slow moving company here. So revenue is actually down over the past 10 years, down by 1.57%. It's a big beast of a company. I think we covered it in our last video, was around $68 billion. So it is down in revenue, but it has increasing net income of 10.86% over the past 10 years. Its earnings per share has been moving positive, up 27.13%. and its free cash flow is positive, up 24.96% over those past 10 years. So here, during that 2020 period, generally this company, you can see over the past 10 years, it doesn't move very fast. It doesn't move very hard. If we can throw in our price in here as well, we can see here that the price overall just stays pretty consistent. Over the past 10 years, it's put on roughly a 9%. Actually, let's go ahead and throw the total return level. Yeah, total return level. So this is with dividends reinvested. So, or just paid out to. So over the past 10 years, with dividends being paid out and the company appreciation, you would have returned roughly a 14% year on, average return on year. So overall, it's pretty positive. That's in line with the S&P 500. They're 7 to 10% average per year. So here we have Colgate up 140% over the past 10 years, or roughly 14% per year. So pretty positive there on Colgate. Hormel Foods, on the other hand, you can see that these numbers are much larger. We can see that the total return for Hormel Foods is 290%. So that actually breaks down to be 29% growth for their capital appreciation on average per year. In the orange, we have net income up 91% or 9.1%. In the green, their earnings is up 90%. In the blue, their free cash flow is up 38%. And in the purple, their revenue is up 21%. So Hormel Foods has a much higher price appreciation, growth potential versus Colgate. I'm not sure of the current market cap of Hormel Foods. I'm not sure if it's smaller or larger versus Colgate. I just know that when I was looking into Hormel Foods, so Hormel here has a market cap of 25.8 billion. So about, a third of what Colgate is at. So it still has the potential to be growing very nicely into the future. And Hormel Foods is in one of those areas right now where if they can change their product lineup and go with like the whole meatless, vegan, gluten-free, dairy-free, so many products are out there right now sticking these labels on them, and people are buying them just because that's sort of the craze right now. So Hormel Foods has the opportunity to take advantage of the current consumer market and benefit them positive. So these are two positions that I recently started adding to my portfolio, and Procter and Gamble also shows really good signs of being positive here. So if we go ahead and look for the past 10 years, Procter and Gamble, their stock market performance up 193%. That's an average return of 19.3% for 1 year. They're in the market cap here. Actually, we can take up market cap there. Their free cash flow up 62%. Their earnings per share up 26% over the past 10 years. That's 2.6% on average for their earnings. So not a big growth company there either. Their net income is up 10.43. So that breaks down to a little over 1% on average per year. So again, Procter and Gamble, probably not probably a fairly large market cap if we were to bring that in there as well. So this one's, one of those slow growers, and their revenue is down. So similar to Colgate, their revenue has been decreasing. So they've actually been bringing in less total money, but they've been finding ways to either automate or cut costs, and that has increased their net income overall. So even though they're not making as much money as they did in revenue, they're still able to cut costs, lower their expenses, and increase their overall net income. And let's go ahead and look at their market cap here, which is sitting at 70.95 billion. So very close to what Colgate's at. So Colgate here is at 69 billion. So yeah, both are right on the dot. And that is why they have much less growth potential versus Hormel Foods, which is sitting at a market cap there of 25 billion. So all three of these companies I feel are still very, very strong companies. They all pay out every quarter. So let's go ahead and take a look here at Hormel Foods and Colgate and take a look at their dividends here. So Colgate here has 20 years of growth. They have a very slow growth rate of 2.96. They have a very safe payout ratio of 54.94. They have a current starting yield of roughly 2.2%. So overall, pretty positive there, for their growth potential, their safety as far as their payout ratio. But again, Colgate's more of that safe play. I feel that here in the short term, it'll offer some nice upside potential, maybe, more as far as stock appreciation and not so much as that dividend, growth year over year. Whereas Hormel Foods, if we take a look at this one still around a 2.05, so around a 2% starting yield, has again a very safe payout ratio. It already has a higher stock appreciation ratio, stock appreciation history, but it also offers a 5-year growth rate on the dividend of 12.8%. So every 5 years, this company, if you were to buy and hold it, you would see the dividend basically double. Using the rule of 72 here, if you go 72, so 72 divided by 12, 6 years. So every 6 years, your dividend, whatever you had bought it at 6 years ago, essentially with their current growth rate trajectory, it would double every 6 years. And they've been growing and paying out their dividend for the past 21 years. So if you guys are interested in any of those threes, and Hormel Foods there, and Colgate, and then the other one here was Procter and Gamble that we had discussed. Let's go ahead and take a look at that one as well. And Procter and Gamble has 64 years of growing and paying out dividends, 4.05% growth rate, a very close payout ratio of 61.82. I wouldn't say that's risky at all. A higher yield versus the other two at 2.57, and pretty solid overall. So this one pays out in May. This one pays out, I guess we could say Colgate is a, it's a 1, 4, 7, and 10. So every January, April, July, and October, it goes ex dividend. So 1, 4, 7, 10. Here with Hormel Foods, it's another 1, 4, 7, 10. And this one's a 1, 4, 7, 10. So each of these companies goes ex dividend on 1, 4, 7, 10. And it looks like they all pay out roughly, every, 3, 5, 8, 11. So if you guys are looking for any stocks in those areas as well. So that is basically it. So we're going to go ahead and make our buy. And again, I'm going to be going with Colgate today because I feel it has the best upside potential here in the short term versus Hormel Foods, which, here in the after hours, it is down 1.3%. So here is a better buying opportunity for me in the future. As it breaks down, I could buy more of it. It's already in the portfolio. So all we need to do is just kind of wait for it to fall a bit, and we'll just average more into it. So here, what we're going to do is go ahead and select Colgate, which is already down in the portfolio by 0.24%. So that is perfect. I'm already averaging down on this position. That'll lower my cost basis. That'll increase my yield on cost for this position. And we're going to go ahead and make our buy there and go back to our portfolio. So here we have one buy coming up. If we go ahead and view the details, we can see that we are purchasing Colgate, $212.11 of Colgate going in tomorrow. So that is basically it for this video. Let me know down in the comment section below, what companies are you added into your portfolio recently? What sector, what industry are they in? Are you looking for anything specific? And of course, if you haven't gone over to my channel, checked out the community tab, let me know what's your favorite REIT, and that is basically it. If you are brand new to the channel, have not yet subscribed, go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time I release a brand new video. And of course, give this video a thumbs up, make it blue, and I will see you guys in the next video. Bye-bye.